Folks, what is going on today? All right, so today what I wanted to do is double down again on return of capital as a tax structure. All right, a lot of people have been asking, what does return of capital look like compared to a dividend, an ETF, without any return of capital structure? So, what I've done is created another Google spreadsheet, a calculator that looks at an asset, an ETF, a dividend paying ETF with 100% return of capital versus one with 0% return of capital. And we can compare and contrast the two of them. All right, guys, so let's just jump right into it. All right, folks. So this calculator, among all the calculators, will be available via my Patreon. Guys, we're up to 150 members. If you want access to the Patreon, please go to the description link below and you can sub to the Patreon. It's $5 a month to get access to all the calculators. I have at this point 25 different calculators for you guys to get access to. And there's also an upgraded tier if you want to do a one-on-one chat about personal finance on a monthly basis. So if you guys want to support the channel, I'd really appreciate it. Jump over to the Patreon and sign up. All right, so we are here at the ROC return of capital versus no return of capital comparison. Okay, guys? And we're going to compare an asset that has 100% return of capital tax structure versus 0% return of capital tax structure and compare and contrast the two of them to see what they look like and what are the differences. All right. And guys, I want to just first explain what return of capital is, all right? So effectively, it is a tax deferral, all right? When you receive these dividends, all right, what's going to happen is these dividends will reduce your cost basis. The cost basis is effectively how much you've invested, your initial investment amount, all right? And what the dividends will do is will effectively bring your cost basis down instead of you paying tax on those dividends up until the point where you bring your cost basis down to zero. After that point, you start paying tax on your dividends. All right, and this is not just a free lunch here, right? You will pay the tax for the cost basis you've reduced at the end when you sell the final asset. All right. So that's it in a nutshell what return of capital is. And we will visualize that right now for you. But I want to hopefully make it clear and we'll visualize it for you to maybe make it even more clear. But let's do that now. So we have this calculator here. We have this calculator I've built. All right. And we have some simple inputs that we will inject. All right. So our tax rate is going to be ordinary tax rate of 15%. Our expected dividend yield is 10%. Our starting value is going to be 100K. So I'm going to change this to 100K. All right. And our stock appreciation or ETF appreciation per year is going to be 2%. This is something like QQQI or SPY-I would do. SPY-I in a good bull run usually will do something like, 10 to 12% in yield and maybe have 1 to 2% price appreciation. Okay. And so we have two setups here. We have ETF A, which is going to be an ETF that includes 100% return of capital, and ETF B, which will have no return of capital. All right. So you will, right, with ETF B, you will be taxed immediately when you receive dividends from day one. All right. So let's look at ETF A for now. All right. So we invested 100K. All right. So our starting value is 100K. We received a 10K income because the yield was 10%. All right. So we have 10K income. And our after-tax income is still 10K in this ETF-A. Remember, it's return of capital at 100%. So ETF-A return of capital brings 10K in that initial year, right? 10% of 100K. But now our adjusted cost basis, right? That 10K that we received in dividends will reduce our cost basis. All right. This is effectively how much we paid for the asset. All right. So we will use this income and reduce the cost basis by 10K to give us an end value of 112K, including that price appreciation of 2%. All right. So this end value is the after tax income because we're reinvesting the whole thing. It's the after tax income plus the appreciated asset. All right, so 100K times a multiplier of 2% growth. Okay, or plus a multiplier of 2% growth. So 112 K is the final ending value for year one. Now you can see the clear benefit with return of capital is you are not paying tax on your dividends in year one. Okay. And instead of, again, paying your taxes in year one, you're reducing the cost basis. You're changing how much you've paid for the asset effectively. All right. So instead of you paid 100K, now visualize that instead of 100K, well, with these dividends I've been yielded, I've now paid 90K for this asset. Now year two, 112K. All right, we got 11K in income. All right, and 11K in after-tax income for that year, right? So because return of capital is the structure here, instead of paying the tax on that, it's again continuing to reduce the cost basis. Okay, so no tax on this, and you can see that your cost basis, you start at 100K, and every year with more income yielded, your cost basis keeps depleting and depleting and depleting until it can go to zero, right? You cannot have a negative cost basis. The lowest you can go is zero, which is no cost basis, right? Effectively, you've paid nothing for it in a sense, right? And so again, year two, we've reduced our cost basis down to 78K. So again, this is like, instead of paying the original 100K, you are now paying 78K for the asset, right? But that means a larger capital gains tax bill, after year two, right? Because the capital gains tax bill after year two would be the ending value of 125K minus 78K, right? Whereas if you didn't have any return of capital, it would be 125K minus 100K, your original cost basis, right? You can see where the tax is going. You can see where the tax deferral element is going to, right? You're not, this return of capital structure does not get you a get out of a free lunch. It does not give you a free lunch. You are still going to pay the tax when you sell the final asset, right? And that's because we are deferring the tax. We are writing down the original cost we paid for the asset, and at the end we will pay the tax. So this cycle goes on and on and on, right? We're going to continue to see appreciation here in this simulation. We will see higher dividends, and after year seven, we won't pay tax on the dividends provided until year seven, that when our cost basis goes down to zero, right? After year seven, there's no cost basis left. So we cannot reduce anything else. There's nothing left to reduce. So now we're going to start to pay tax, okay, all throughout the way. And this would be like any normal, dividend that has 0% return of capital, right? This, here we start with 100K. We have an income of 20K on this. We'll bring that down to 17K after tax. All right. And so we will continue to drip. So on and on and on this goes. The end value with this structure would be 824K earned, all right, in 20 years. Going from 100K initial investment, 10% yield per year, and 2% appreciation. Of course, this is a simulation. Things go up and down, but this is purely for more understanding of return of capital versus no return of capital structure. All right. And the easier one to understand is looking at ETF-B, which has 0% return of capital. And what happens with that? Well, you start your investment, and that is 100K initial investment. All right. Your dividend income is 10K. All right. But then we have our 15% tax. And so we're left with 8,500. All right. You can see your cost basis does not adjust, right? In the other example with ETF-A, your cost basis is being brought down by the dividends, by the dividend income. This now, your cost basis will always stay the same at 100K. Of course, it will go up a bit when you drip. If you drip in, we're not, going to get into that today. Maybe we'll do another edit in the future to look at cost basis when we include dripping. that's fine. But today I just wanted to simplify it. All right. So from your initial value, right? Um, you get your 10K income. You reduce it down because of the taxes you have to pay on the income for that year, and your end value is the appreciated asset plus your income after tax. Okay, so 110K. But you can see already a difference, right? For ETF-A, we have the benefit of having a more assets to work with because we're not stripping away the assets via tax. That isn't going to, and then we have the benefit of compounding the extra money that isn't being taxed immediately over the long run, right? So in year one, we have 112K for ETF-A, and for ETF-B, we have 110K. You can see that difference is the tax difference, right? ETF-A is not being taxed immediately. ETF-B is being taxed immediately. As a result, we have more capital to work with ETF-A. All right. So the big difference with ETF-A and ETF-B is, again, return of capital. You're reducing the amount you've paid for the asset up until there's no cost basis left. With ETF-B, that is never the case. You are just getting it paid tax right from the get-go, and you're going to get paid tax. You're going to pay tax all throughout the way. And guys, you can jump into the simulator and run these numbers yourself. All right, so guys, now let's sum it all up. Let's look at this as a sum total after 20 years. All right, so with ETF-A, which is the asset with 100% return of capital tax structure, you would have yielded after 20 years 579K, almost 580K in dividend income. Whereas ETF-B, the no return of capital, is going to have 525K in dividend income. All right, and this is because effectively that extra 100K you got to tax defer and then reinvest into the asset allows for more compounding and for more potential yield and for more potential income, right? So you can see that tax deferral keeps more assets in the fund and in your pocket so that it can compound. All right. And so ETF-A's capital gains is 724K. In this case, we are going to take the final value minus your original investment, right? Because again, you did invest in the 100K. So 724K is the capital gain. For ETF-B, 659K. Your capital gains tax is going to be on the final value, okay? So we're not going to minus anything out of the capital gains here, right? The capital gains tax. It's going to be just the end value times 15%. Why? Because you've reduced and wiped away your cost basis. It's like you were given this for free in a sense. It's like you paid your way down so that there is no initial investment to it in a sense. And so from that point, right, we're just going to take that final value and then multiply it by 15% to understand what the capital gains tax is owed, right? Again, you can't, if you bought this for 100K, but again, we wiped away our cost basis down to zero. So now it's 15% times this number. So capital gains tax 123K. Okay. End value, like we said in the just down here, is 824K. For ETF-B, again, 525K taxable income, capital gains, ETF-B capital gains is going to be 660K. And then the capital gains tax is certainly going to be less than ETF-A with 100K. And the end value is going to be 659K, guys. And so should you have invested in the return of capital ETF, the 100% return of capital ETF, versus, and we compared it against the ETF-B, which is no return of capital, with the exact same yield, the exact same appreciation happening, for the 100% return of capital structure, you would have seen a 65K gain, a 65K increase in the value as a result of the ability to defer those taxes as opposed to paying for those taxes upfront and not allowing the potential compounding of that money. You do sacrifice that potential compounding impact, right? So the return of capital structure unlocks capital today that can be continued to compound should you be dripping, reinvesting back into the fund. Guys, I hope this was clear. Again, it is a confusing topic for some. For others, it is more clear. But effectively, return of capital, it's a tax deferral mechanism. In a sense, maybe similar to a 401k, in a sense, but also different. And so that mechanism unlocks more capital today to allow you to compound, and you can see its effects over time. Yes, we'll pay a higher capital gains tax in the end because we don't have any cost basis left. But, and this is the big but you get to unlock that capital today instead of paying tax on it so that you can compound it. And guys, if I were to change this to a million, this is where it really starts, showing a big impact, guys, because the variance between going with ETF A, which is the 100% return of capital, versus ETF B, no return of capital. Now we have a 652K gain with the ETF A structure, right? So the more you can defer, the taxes effectively, the more capital you have on hand to work with and compound, right? And so that impact of not paying today is substantial. It's substantial in my opinion. Let me know if you see this differently. But as far as my math here and what I'm seeing, guys, like the tax deferral mechanism is quite effective to put more funds in your pocket, letting it compound and letting it ride, guys. All right, guys, if you want access to the calculator, please jump into the Patreon, sub to the channel, comment below. All the best and cheers.